I'm going to show you how I calculate the stock for Ford Motor Company, and I do that using a discounted cash flow model. And watch the whole video, there'll be a lot of pop-ups with more information. So let's get started. So the first thing I need for the model is the market cap. That's 23.5 billion. And that's how much the company is worth according to the stock market. And then the stock price is up here, 595. And now we can figure out the shares outstanding because it's just a market cap, 23.5 billion, divided by stock price, 595, equals 4 billion shares outstanding. So next we're going to get the free cash flows, and this is the cash that's remaining after operating the company minus capital expenditures. And this is how you calculate the value of a company. You estimate the future free cash flows and then discount that number back to today's value. And that's exactly what we're doing in the video today. And next is net income, and that's a profit and loss on the income statement. And then last is going to be the revenue, which is also on the income statement. And let's look at the numbers just to make sure they look okay. So it's nice to see their free cash flow of 12 billion and 11 billion. It drops a little in 2018, but it's still pretty healthy at 7 billion. So that means that operating with a lot of cash remaining after running their day-to-day business. So that's a good sign. Net income looks pretty good, except 2019, they had almost a break even that year. And but you could see cash flow is still healthy at 10 billion because in the income statement there's accrual accounting. So when they buy things in prior years, they pass it through in future years. So maybe a lot of things were passed through in 2019 and they had a lot of losses. So but always look at free cash flow. That's the best indicator of the health of a company. And revenue is pretty consistent year to year. Now let's look at the capital structure of the company, because we need to know the discount rate we need to apply to the future cash flows. So they pay $1 billion on interest on their debt. And let's see how much debt they have. We'll go to the balance sheet. And then we'll go to liability section. And then the current debt is $53 billion. And the long-term debt is $100 billion. So they pay under 1% interest on the debt, which is really low. They must have got really good terms with their creditors. But let's get their effective tax rate because interest payments are tax deductible. And sometimes it's hard on the income statement to figure out which year is the best because of the accrual accounting and passing through expenses and losses from prior years. But it looks like 2016 looks to be the best year. They had 7 billion of income and 2 billion of taxes. So when we deduct the taxes from the interest payment, we get a cost of debt of 0.46%. And next we need the beta, that's a volatility of the stock. So that shows you how volatile the stock is compared to the rest of the market. And that's 1.3 right here. So it moves a little more than the market does, so it's not too volatile. Let's get some more information from the balance sheet. Let's get their current assets. Those are assets which can be converted to cash within 1 year. And those usually include cash, accounts receivables, and inventory. And they have 114 billion of current assets. And let's get their current liabilities. Those are liabilities that are due within 1 year. And last, we'll get their equity, which is total assets minus total liabilities. And that's the value of the company according to the balance sheet, and that's $33 billion. Let's get their operating income, or EBIT. And you can see in 2019, they didn't really have much operating income, only $500 million. In the prior years, they had $3-4 billion. So it looks like just that year they had a weak year, and it probably did get worse in 2020 because of coronavirus. Sales are down. Let's just put into the model. So we figured out the cost of capital because it's a blend of cost of debt and cost of equity, and that's what we call the WACC. It's 2.54%, and that's what we're going to discount the future cash flows by. So we estimated the future free cash flows for 4 years. We did a terminal value, which is all years past year 4. We discounted those numbers back to today, and we get a value of the company of $23 billion. We divide that by 4 billion shares, and we get an intrinsic stock price of $5.85. So it's trading at about intrinsic value. Let's see what Simply Wall Street says. They have $233 as their fair value. So I don't know exactly what they do to calculate the intrinsic value of the stock, but they obviously use different parameters than I do. And the probability of default, according to my model, is 25% within the next 12 months, just because they have so much debt. And you can see historically, the past 5 years, they were trading a lot higher, but they've come down a lot. Seems to be a good value. And to give you more insight into my models, I actually have 4 models on this spreadsheet, and this is the most aggressive. So this is the harshest on a company. This is the only model I got a value even close to where they're trading at. You can see up here, it says number 3. Like if I change that to number 1, it's calculating the value of the stock at $1,000 a share. At 2, $21,000 a share. And at 4, $175,000 a share. So 3 is by far the most aggressive, because you can even see we're estimating future free cash flows for 4 years at under 100 million, where in the past it's been 7 to 10 billion. So it's a really hard company to value because the numbers are so good, but they're trading so low. But the reason they're trading low is because the future of the company is just not as predictable. And if you put your blinders on and just look at the balance sheet and know nothing else, you would think it's a pretty decent company. It should be trading at a much higher than $6 a share. So I don't know how to build into the model future market sentiment. I don't think anybody can really predict that stuff. But let's look at the ratios of the company to get some more color. So they have an enormous PE, because that's price of stock over earnings, and the earnings were just so low in 2019. Like, it's looking at the 47 million from 2019. Let's say we looked at the 3.7 billion the prior year. So instead of E18, we'll go to D. Now it drops to a normal number of 6.4. So that's why you have to look at ratios over time. It's hard to look at one ratio and just make your decision. So they have a really good PE. It's just this 1 year they seem to just have a low amount of earnings for whatever reason. But the other years it seemed fine. Price of sales is super low because that's price of stock over sales per share, and the price of stock is just it's so little. That said, that indicates that investors are willing to pay 20 cents for $1 of sales. So that's just a great return. The lower this ratio, the better. These 3 ratios, price to earnings, price to sales, price to book, the lower the better. So the price to book is under 1, which indicates a really good value. On good current ratio, they're 1.2, so they can cover their current liabilities. ROE of 0% because they pretty much have no income, because ROE is income over equity. And in 2019, they just had such a small number, 47 million. And they have 33 billion of equity on their balance sheet, so it rounds to 0. It's not really 0, it's like 0.14. Interest coverage ratio, that's a concern. They can't even cover their interest payment, but that's 2019. They had a really bad year, and they have tons of debt, 82% debt, so they're really leveraged. And I don't have any other companies to compare them to because this is the first car manufacturer I did on this channel, but I'll try to do more. I can't do Tesla because they just report all negatives, so the stock price comes out negative. So even the most conservative model doesn't work for Tesla. So let me know what you think in the comments. Really appreciate you watching the video.